GameStop stock breakdown. What you need to know. Hey everyone, today we're diving into GameStop's latest stock performance. Let's break it down. Recently, GameStop released their first quarter fiscal 2024 results, and it wasn't quite the blockbuster hit they were hoping for. They pulled in net sales of $882 million, which is a big drop from $1.24 billion in the same time last year. Analysts had hoped for $900 million, so GameStop fell short there too. Now they did narrow their net loss to $32.3 million, or about 11 cents per share, better than last year's $50.5 million, or 17 cents per share. But they still didn't meet what analysts had expected. On top of that, GameStop announced plans to issue up to 75 million more shares. This comes after they recently sold 45 million shares, raising over $900 million. All this combined bad news led to the stock dropping over 39%. Let's talk about how profitable or not so profitable GameStop is. Their gross profit margin, which measures how much money they keep from sales after covering the cost of goods sold, improved to 27.7% this quarter from 23.2% last year. That's a plus. But here's the catch. They've got really high selling, general, and administrative expenses, which took up 33.5% of their net sales. The net loss for this quarter was 3.7%, a tiny bit better than last year's 4.1% loss, but it still points to serious profitability issues. So what's their return on equity? ROE basically tells us how good the company is at making profits from shareholders' investments. Unfortunately for GameStop, ongoing net losses keep their ROE pretty low. Let's talk competitive advantage, or what's known as the moat. GameStop's moat has been shrinking due to the rise of digital game downloads and competition from big retailers and online platforms, but so far it hasn't made a significant impact on their revenues. Moving on to intrinsic value, which is what analysts think the stock should be worth based on current earnings and market conditions. For GameStop, it seems like their market price is higher than their intrinsic value. Analysts have set a price target of $11 per share, suggesting there's more than a 55% downside risk from current levels. Earnings yield. Earnings yield gives us an idea of how much return we're getting on our investment based on the company's earnings. For GameStop, it's negative right now because they're not making profits. Add the recent stock volatility into the mix, and it makes GameStop a tricky investment choice at the moment. Competent and honest management. How about the folks running the show? CEO Ryan Cohen has been making moves to cut costs and aim for long-term profitability, but without concrete updates at the recent shareholder meeting, investors are a bit disappointed. GameStop's basic business model of selling video games and consoles is easy enough to understand. But with their new focus on digital assets and NFTs, it's gotten a bit more complex. If you're thinking of investing, you'll need to consider both the retail and the digital sides of the business. Long-term investment horizon. For those of you looking at the long game, GameStop comes with high risks. So to wrap this all up, GameStop is facing big challenges in improving profitability, holding on to its competitive advantage, and achieving positive returns for shareholders. Their latest financial performance and strategic shifts suggest that potential investors should tread carefully. Don't forget to like, subscribe, and hit the notification bell for more stock breakdowns and investing insights. Thanks for watching.